Market Outlook, Calendar Week 22. Calendar Week 21 was less a classic schedule of releases and more a condensed picture of events. The data environment showed no uniform direction. China delivered solid activity signals, while the United States painted a mixed picture through housing, labor market, and purchasing managers' data. In Europe, weaker industrial impulses stood alongside more stable services components. The market did not react to a single data point, but to the combined effect of interest rates, the dollar, yields, energy prices, and risk appetite. The Fed minutes remained the central monetary policy reference point because they brought the central bank's reaction function into focus. At the same time, several news strands became more concentrated. First, the discussion around stretched valuations in the AI sector moved more strongly into the market. High capital expenditure, concentrated earnings expectations, and debt-financed infrastructure projects increased sensitivity to margins and demand. Second, the European Commission opened a consultation to review MiCA. The review process runs until the end of August and concerns issuers, service providers, and stablecoin structures. Third, the credit system showed signs of stress. Private credit portfolios, redemptions in semi-liquid vehicles, and valuation questions around smaller funds were discussed more intensely. Fourth, the Iran conflict remained a geopolitical disruptive factor. The Strait of Hormuz came back into focus because energy, shipping, and negotiation lines affect oil prices, freight routes, and risk premia. The mechanical transmission chain is clear. AI valuations and credit stress feed into digital assets through risk premia, refinancing costs, and equity volatility. MiCA works through legal clarity, stablecoin structures, and market access. The Iran conflict works through energy prices, inflation expectations, real yields, and the dollar. When several channels are active at the same time, liquidity, order book depth, and derivatives positioning become more important. The transition into the current market environment remains BTC-led. Bitcoin dominance stands at 59.9%, while the Crypto Fear and Greed Index is at 25, placing it in the extreme fear range. This combination does not point to broad risk appetite, but to capital being tied to the most liquid segment and to limited market breadth outside Bitcoin and Ethereum. Quantum data analytics did not develop any research signals in this environment. The reason is purely operational. The market regime was event-driven, several news channels were active at the same time, and short-term moves came from macro data, regulation, credit stress, and geopolitics. In such phases, the risk of regime misclassification increases. For that reason, filter adjustment and retraining were the priority. No activation took place because stable setup patterns were overlaid by external impulses. For calendar week 22, the focus shifts to clearly identifiable event windows. At the beginning of the week, US liquidity remains reduced because of the holiday. After that, US consumer confidence, regional activity data, and housing indicators move into focus. The most important data block comes on Thursday with the second estimate of US growth, PCE inflation data, durable goods orders, and initial jobless claims. These releases run through the same transmission channel: growth and inflation. Change interest rate expectations. Interest rate expectations move the dollar and real yields, and from there, pressure or relief emerges for risk assets and digital assets. On Friday, the trade balance, inventory data, and the Chicago PMI add to the picture of US activity. The geopolitical situation remains an ongoing disruptive factor. Reports on the Strait of Hormuz, energy infrastructure, or negotiations with Iran influence energy prices and risk premia. For digital assets, the direct channel is not the political headline itself, but its effect on inflation expectations, the dollar, yields, liquidity, and risk budgets. Operationally, the US time windows on Tuesday and Thursday are especially relevant. Elevated volatility and slippage arise where data releases meet thinner order books, positive funding costs or local token unlocks. Altcoins with lower depth react more strongly to individual orders and derivatives unwinds. BTC and ETH remain the reference markets for market absorption, liquidity, and the first reaction. Research signals remain tied to clear market structure, confirmed liquidity, and a calmer event window. This post does not constitute investment advice and contains no recommendation to buy or sell. It is intended solely for informational and research purposes. Quantum data analytics. Analytical, strategic, innovative.